imagine you're, crypto wealthy in this next bull cycle. You make a lot of money and you're at, $3, $4, $5 million of Bitcoin or Ethereum. Your first problem is you're like freaking out about taxes. If you sell, you have to pay a ton of taxes. We built a entirely smart contract based lending protocol that allows people to get liquidity in a hedged way against their assets.
So excited to be back here for another episode of Proof of Coverage. I have John Wu back as my co-host again for another episode. Just as a quick reminder, John is the president of Ava Labs and was previously the CEO of SharesPost and has just been, one of the leading voices in the space around what he's doing in Avalanche, DeFi broadly, and tokenization of real-world assets. And then our guest today is J. Paul Meyer, who is the founder of Collar Networks, who's trying to build a platform that'll allow you to borrow against crypto without getting liquidated, so you can defer cap gains and monetize debt at the end of the day. And it's one of these things that can make up a fundamental primitive for how the new age of wealthy people and, retail as well kind of interact with DeFi rails in order to make the most out of their money. So, J. Paul, we're super excited to have you on here today.
Appreciate it. No, thank you, Mahesh. This is is truly an honor. I'm excited to talk through some of this stuff with both you guys. Look, we're seeing it live in terms of like what the ETF is allowing, new customers and new kind of investors in the space to really do. It's kind of the OG form of tokenization. TradFi had to figure out a way to like make it easy to buy stuff, so they came up with ETFs, and it sort of solved a lot of the problems. And it was extremely innovative at the time, but now we're able to use it to make it easy to access really any market. And so now that that's happening and we're really starting to see things flow, I think Florida just announced that they're buying Bitcoin on their balance sheet. I don't want to, please check me on that. I don't want to,
no,
push
you're right.
Years, but basically, we think that, look, there's going to be a new class of kind of wealthy in the world, and they're going to need financial services just like everybody else. And hopefully those financial services run on, much faster, better rails. I was right before this, for some reason, diving through all the Dodd-Frank regulations in terms of swaps and stuff like that, because that's compliance that we're going to run up against. And you need like $20 million to be able to be a swap dealer that's registered. Now, there's de minimis exceptions and cool stuff that we do that we're focused on for our business. But, the only reason they need all that capital is because they have ways where things can go wrong. And, in DeFi, obviously, you have hacks and those things are getting fixed. But it's much better when you have immutable smart contracts that sort of set the rules for you, and you don't have to like go to Basel every year and get together and like figure out the rules, right? So I think that's what's really exciting about the space, and like that's what we're trying to it'll be pretty funny if a bunch of like 18 to 30-year-olds kind of plus figure this out more in a more systematic, like airtight way than everybody in Basel.
Absolutely. And so maybe just for a little bit of background before we get into it, I've known J. Paul it's been more than 8 years now, man. He was in my class at Harvard College, always one of the more thoughtful thinkers around financial services and technology. We also, first job together worked at Goldman. He was on the trading side. I was on the investment banking side, but having a lot of conversations even at that time. We were both pretty interested in crypto and more broadly in tokenization. So, it's been awesome to sort of see his progress and the platform that he's been building since then. But J. Paul, I want to start with a very fundamental question, just given our experience at Goldman and our time there. Like, does the world need Goldman Sachs? Like, what do they even do today?
I'd say the world badly needs Goldman Sachs. As much as as easy as it'd be for me to run with the narrative of like, F the system or whatever. I think we're all grateful for 3% mortgages back when they were a thing. I think, not enough kind of advocacy has really been done on behalf of some of these behemoth brands. I mean, they make, a lot of these things possible. Obviously, it is all replaceable by smart contracts one day, but the same way we had, telephones were like really important in their time. Like we needed that tech to sort of, communicate in various wars or different parts of history where that was the meta. I think over time, the meta shifts and technology improves. And, I'm sure people are going to adopt the latest, technology to try to make sure that they can like run their business at the end of the day. But look, I'm extremely grateful for all the things that I learned, and I think it's a great way to go figure out how the world works very quickly. I'm sure on the banking side, seeing like why people are buying certain companies or why people, why so and so wants to raise capital and who they're raising it from. If you kind of take a step back and say like, what's really happening here, and sort of use it to, integrate that into like your long-term career and choices and looking at how stuff works. It's extremely powerful to be able to get to see that at such a young age. And so, yeah, I think the world badly needs Goldman Sachs. I think that's like an unpopular take, but yeah, no, we all love fixed rate mortgages. Like, where do you think the interest rate swaps come from that make that happen? Like, where do you think so there's somebody, some thankless kind of person in the front, middle, and back office that are, making America's housing market a better place. Now, obviously they not they, but the market screwed things up in 2008. But let's not throw the baby out with the bathwater. But yeah.
Yeah. No, it's an interesting take to almost think about Goldman as like one of the, earlier adopters and wildly successful users of maybe like the last century's generation of technology. Like they were the guys that figured out like how to use phones to trade, how to build trading systems using like original computer frameworks that existed maybe 60, 70 years ago, and how to do that in a way that actually added efficiency into the market. So that's a pretty interesting way of framing it. But how do you think Goldman got so big then? Was it just the mastery of that technology? Was it the people?
I think it was product market fit and people, like every good thing, right? I think it was, I think they started on, oh man, I'm going to get my history wrong here, but they started on obviously a lot of deals. I think it was the Sears Roebuck IPO. As capital markets were starting to heat up, like that was the first, and it's funny because doing startups sort of forces you to think about why now. And I think there was you can sort of see interest rates, go up to super high levels in the 80s and then start to come down and understand why the bond rallies were happening, why the, bond traders were such a big deal, because rates were so volatile. So everything peaked at different times. Salomon Brothers got big when rates were going nuts. I was talking to somebody recently who, was explaining how basically things used to trade in 8ths and 16ths, and then decimalization was like this huge unlock for markets. So I only would have known, only knew what that was rotating through GSET, which was like an electronic trading desk. So, and reading Flash Boys. But luckily, a lot of this, I think it's like Mark Andreessen or somebody was like, there's a lot of alpha locked up in like books from, call it, 50 plus years ago, because that's where the best information went, because they didn't have, call it, podcasts and stuff like that. So
I can shed some light on how Goldman got so big, from my personal experience. So I started my career after college on the buy side as a principal investor at places like Tiger and Kingdon, and Goldman was on the sell side, and they covered me in various sectors and stuff. One of the reasons why they got so big is there is an unbelievable capability in human resources or something in recruitment, because of the brand became self-fulfilling, and they keep getting great people like Mahesh, like yourself, J. Paul. And these great people were always good at being creative and coming up with insights and being, generally speaking, good partners with the buy side friends, unless it meant there was a fixed pie. And Goldman Sachs, you have to always be careful with Goldman Sachs if it's a fixed pie. But they were generally good at creating, growing the pie and making it better, making 1 + 1 = 3 somehow for both their customers as well as themselves. But that brings us to a whole different world today. I'm older than you guys. This is when they first started covering me, it was pre-IPO of Goldman. And then obviously they continued to cover me at the various places I worked post-IPO. But the thing here is today, I think 5 banks in the U.S. now control over 50% of the deposits in the U.S. There has been, and Mahesh, you were an investment banker, but in your dad's day, I think you worked at Morgan Stanley. Probably one of the big things they did in the FIG group there was consolidating of the banking sector. So there's become fewer and fewer choice in the U.S. And there's a movement towards Web3 is probably because people are fearful of the consolidation of what we've seen in the world. Banks are consolidated. 5 in the U.S. control so much of the deposits. 5 or 7 companies in California, technology-wise, control basically almost every minute of your day, from your e-commerce to your searching to your streaming of videos to your social media, and basically collecting your data, your digital fingerprint, which is also an asset. So the promise of decentralization of Web3 is that it gives everyone a chance again against these big boys. So given that backdrop, I'm not sure this is why Collar Protocol came about, but how do you think you compete with this hugely scalable big boys like Goldman Sachs?
Yeah, I think it's going to be hard for them to. I mean, look, I think it's going to be hard for them to hire Solidity engineers and learn a lot of the details and really go deep on this stuff and figure out audits. Obviously, you can throw money at it, but I think it takes time and expertise and curious people. And so, we've focused on sort of having just much more scalable infrastructure that's sort of at a much lower cost and kind of making things very streamlined with smart contracts. So that's been the focus. I think there's definitely, I think it's also being able to sort of spend a lot of time and focus and have it be your top priority to like onboard an institution. And that's the advantage you have as a startup, is being able to sort of throw 100% of your focus at something and get it done, and not kind of, take a week to respond to the email and have it not be a priority and run into committee and stuff like that. I think that, those are all great, setups inside the firm for a reason. But at the same time, nothing substitutes for like just straight elbow grease and kind of making it happen and figuring out, what the issues are. Because whatever, problem a client brings up in terms of the onboarding process, it's like somebody's got to call the lawyer, somebody's got to make it happen and be wildly incentivized to make it happen. So I think as incentives get more and more diffuse for larger companies, I think it's harder to get the activation energy to compete with startups. So that's, one thing I've only been able to see in terms of, learning about crypto and incentives and stuff like that.
Is Collar going after a different segment, meaning the individual, the accredited, the qualified investor, and providing access to those to things that, derivative and structured products on the institutional levels are made available by Goldman Sachs?
Yeah, so more kind of high net worth individuals in the crypto space. A lot of that is in non-traditional demographics in terms of like who their wealth advisors, I'd say, are reaching out to right now. Folks in Puerto Rico in the Bitcoin world, a more global audience in terms of like different jurisdictions around the world and figuring out sort of where those people come from. But yeah, our focus is definitely more high net worth family offices that want to onboard and be early adopters of new technology and also have large positions that they want to get, tax advantage liquidity against. So that's sort of what we found is sort of the niche that we're really going after. And then, we've even started to get some traction with miners that are Bitcoin miners that want to obviously have financing. Now, one of the big tougher pieces there is lending against such a volatile business is very hard. If you hedge the assets up front by swapping them for cash and having a cap involved, which is what we do, you're able to actually make that work because it's a hedged loan. So that's one of the big kind of unlocks that we've found, and for them wrapping BTC with BitGo like isn't that big of a deal. They're not like super obsessed on the custody, full ownership autonomy side. They're running a business and they're commercial. So that's been one thing we found.
Given that you've been at Goldman, are there any weaknesses at Goldman besides the fact that they're too big and you have, you as an entrepreneur, you're able to roll up your sleeves and have less bureaucracy? What are some weak points that you can penetrate and help you succeed at Collar?
I think it's just I don't really think about it that way in terms of like, I know how hard it is to get something new done there. And so, I can kind of go more into my background, but I did I worked on a couple accelerate projects inside of Goldman, which I actually thoroughly enjoyed. It was one of the best experiences I could have really had. In terms of learning how to go get legal opinions and go do things the right way. And so, but it's very hard to do new things. I think you could say that about any large firm. In terms of other weaknesses, I think like it's also not even weaknesses, but just if you look at like Goldman's biggest priorities, it's getting to be number 2 and 1 in different categories as opposed to number 3, if they're ever 3, which they're usually 1. And then if they're 1, it's protecting being 1 and making sure you get the right people and talent and all that stuff. Like, it's hard enough just to manage that large of an enterprise and maintain talent and stuff like that. So I think, for them, there's other priorities that fit their balance sheet better, that fit sort of, what their number one, like fit their sort of priorities better, that I think are, it's, you also don't want to be adopting too late. You have to be out in front of it to go figure out all the complexities. And it takes years, especially at a large firm. So I think it's a timing and speed limiter. But when it comes to, eventually getting there, it's certainly, now clients don't really enjoy switching. That's the other piece. If they know everything works really well and that experience is pretty unrivaled and it's, like white glove onboarding, then they'd rather just buy from whoever they're currently buying from is the other client behavior that we've seen.
No, it reminds me of, John knows very well, there's a very famous professor out of Harvard Business School named Clayton Christensen that came up with all of these theories around disruptive innovation and the way sort of small, scrappy startups compete with the biggest companies in the world. And, his theory, in a very simplified, fundamental way, like simplifying a lot of different things, is that the biggest incumbents really struggle to scrap with startups because disrupting themselves ends up leading to degradation in their own revenue pools and in their own business to begin with. That is unpalatable to public investors. It's unpalatable to people that, have been involved in these projects for tens, if not hundreds of years. And cognitive dissonance that gets created by the fact that they can't decide then to, disrupt themselves gives opportunities to all sorts of scrappy startups with completely different business models to, start with a very niche proportion of the population and deliver just a gangbuster service to that part of the population and then sort of scale it the mainstream over time. And I see a little bit of that happening here, which is, one of the things that excites me a lot. And so, with that, I'd love to talk maybe a little bit about Collar in particular. And in particular, how your background maybe plays into what you're building. So it would be great if you could maybe start by telling us a little bit about what it is exactly you're building and how your background sort of informed the choice of the problem that you're going after.
Yeah, definitely. So imagine you're, crypto wealthy in this next bull cycle. You make a lot of money and you're at, $3, $4, $5 million of Bitcoin or Ethereum wealth. Basically your first problem is you're like freaking out about taxes. You have no idea. Like if you sell, you have to pay a ton of taxes. Now there's nothing wrong with taxes, but obviously we want to make sure that like we're optimizing and, acting in our own best interest in terms of, being thoughtful around that strategy. So basically, we've built a entirely smart contract based lending protocol, that allows people to, well, really more of a borrowing solution, that allows people to get liquidity, in a hedged way against their assets. So, right now that's in the form of basically a front end that you go to at beta.collarprotocol.xyz. And basically you can say your LTV, what asset you want to borrow, and the asset and the amount, and basically get quotes from a solver network, in terms of what that maximum return might be, because the trade that you create by doing this is a derivative known as a call spread. Basically you have to have some market maker on the other side of that that's able to hedge that position and basically offer you that upside, and be able to sort of post enough collateral so that if the market goes up, you get paid. And so you also need somebody who's willing to lend, Bitcoin or ETH for you to basically pay a small interest rate for in order to sell that as opposed to your actual collateral. So that's one of the ways that you're able to kind of preserve your tax basis. And so that's kind of, we've made all of that super easy to the point where it looks and feels like Robinhood, where you can just go on and do this. Imagine, I'm talking to a family friend who's actually like working on taking out a HELOC, and it's been, it's been like 2 months of them trying to like put different things in comp and just like figure out how to do that. And it's a total nightmare. And I think actually what Mike Cagney has done over at Figure has been really impressive in terms of like bringing HELOCs on chain and making it super seamless, to do it in, a couple. And that's literally who I sent them to. I'm like, just go use this. Because
for the audience, maybe you want to explain what a home, a HELOC is.
Yeah,
a home
sorry.
equity.
HELOCs are a home equity line of credit. So when your home has gone up in value, basically you're able to borrow against it. So banks will look at, okay, this house on paper is worth X. You've got, is worth $3 million. You've got $2 million of debt against it. Maybe I don't want to lend against that. But if you've only got $1 million of debt against it, there's a lot of juice there in that home in terms of value that you have in your possession. And they're willing to say, look, here's 200 grand, here's 300 grand to go add a deck or add, improve the house, or just, help you manage some debt. And that's a financial product that, millions of Americans, I know mortgages are like 10 trillion, but HELOCs are probably, maybe a tenth of that, probably a little less. But yeah, we think of this as kind of like a BLOC or an ELOC, where you can kind of get access to the wealth that you've created, in a way that, now, just as a reminder, the current status quo is pretty much margin-based borrowing, with Ava or Compound. So, if you go into Ava and put up some amount of collateral, price goes down, you get liquidated. Like your margin called, you're stopped out. And it's a pretty untenable experience for anyone trying to, sleep at night, especially when it's 24 hours. And so, you could wake up to 3 arrows happening and be liquidated. Whereas, with us, you have time to actually post collateral. And the only reason you can do that is because it's hedged. But yeah, so it's funny. I was at a dinner last night and, we all went around and said what we were doing. And I was like, we want to help you, buy a house, or like if you're 10 times as wealthy, like buy a company or whatever you want to buy with your great collateral. And people were just kind of like, yeah, that sounds like something I would literally use because I don't want to sell my Bitcoin when I buy my house. Like it's just, it makes sense.
The time-based angle, I think, is so interesting because it speaks to your market knowledge, which is to say that, if you're just a developer and you haven't spent a lot of time in financial services, you build this and you build like automated liquidations in. But like if you've actually spent time at an investment bank and seen how clients have reacted to things like that going, like you almost have the additional knowledge then that you have to build this human element into the protocol as well to check for, the biases that exist in human behavior in order to create the best customer experience. So yeah, to totally see how, you're taking maybe some of the elements of Goldman, what you learned at Goldman and kind of bringing into this world. But I just want to make sure I understand. So at a high level, I have a bunch of crypto wealth. That wealth probably has some gains. I don't want to sell that wealth because I don't want to pay taxes on it, but I want to access that wealth by theoretically being able to lock that up somewhere and getting capital against that. So I have liquidity today, but I still get to hold my long position. So I have all of the upside for the investments that I've made, but I also have liquidity today that I'm able to go use. And then you have built a very thoughtful framework around how that wealth is managed, hedged, and, some of the human behavior related elements around sort of how that platform operates.
Totally. There's a million details to this, and there's like a lot of, the very important thing to highlight is like, this is not a free lunch. You have to cap your returns at a certain point to get this downside protection and that time-based liquidity. But so that's the trade, right? Like if you think Bitcoin is going to double in a month, this may not be the product for you. If you think it's going to, continue to drift upwards 5-10%, et cetera, basically, this is a better kind of choice. Now, obviously it's extremely volatile, but you can kind of chase and roll your trade as things go higher. So let's say you say, 80% LTV, 20% tab, Bitcoin rallies 20%, and you're like, wow, I just hit my maximum return. Like I'm about to get kind of stopped out. Let me roll that trade. You're going to pay a little bit of what's called bid offer to market makers. Like you're not going to make every dollar all the way up. You might be capped for a little bit. You might, have to pay a little bit of cost to a market maker, but you're able to get most of the exposure and continue to roll that trade. We're working on a feature called auto roll that will let you just not have to think about this and have that just automatically happen. And that works by you providing consent to basically roll at certain levels so that we're not actually taking a fiduciary RIA type management role at all. It's just purely you say, it's like a limit order. You just say, I want to roll this if this ever happens. And so yeah, look, it's a complicated financial product. And I think our number one goal is like simplifying it. We're working on a video right now that just makes it like super simple. But the analogy I like to use is like climbing a mountain, right? You put a stake in the ice, mountain or whatever. And if you fall, like your stake is in. Now, if you really start running and you only have so much rope that you're like, you can't get past, like your stake is holding you down, then you got to take the stake out and move it up. Right. So that's kind of how it works. Or like that salmon ladder thing on American Ninja Warrior. It's like you kind of jump and jump and jump and try to lock in higher. So
I want to build on this because it's refreshing to hear people with actual financial experience trying to create products to further the space. It's literally what Mahesh said earlier. There's a lot of great, intelligent, smart people who are programmers or devs or whatever, and they think through great ideas, but they don't have the pragmatic know-how to actually operate it or affect the change in whatever they're trying to create. And then tying that back to the HELOC situation with Cagney and Provenance and Figure, and then there's a question after that. So I know that situation intimately. Ava Labs and Avalanche worked with Apollo. I think Mahesh worked there at one point as well, Layer Zero, and obviously the folks at Provenance and Figure, to take that HELOC, which he's done a great job in terms of primary issuance, and connect it in a basically compliant way. Avalanche is EVM compatible, so once you get into Avalanche, you can go all over, except for Bitcoin, I guess. Even then, there's a way to do it to make sure that you can access all of Web3 in a compliant way, because there will be more liquidity. Because even if you have a very intelligent framework on how to create this and are compliant, the issue is on the secondary market, it's going to be very hard to find the trade and liquidity. So that's my question for you is, very thoughtful, great framework, but there is liquidity is also depth of markets, not just narrowing the spread. So how do you find that liquidity?
Yeah, no. So our limiter right now is definitely, Uniswap liquidity. So that swap from the supplier to fund the loan goes through Uniswap. So it's our number one limiter right now. We're actually able to lean on off-chain partners. So like market makers to sort of, one thing we're working on building out is actually, and obviously you got to develop it iteratively, right? And get to mainnet and all that good stuff. But one of the pieces is having a swap contract where you can sort of prearrange a swap with a market maker to make sure that you get better execution than whatever you might get with Uniswap, and have that be a backup. So you could basically have a, plan A and plan B. You could even have an auction. Those are all things that we're looking at in terms of the decentralization process, so that we don't eventually have, whitelisted kind of solvers over time. So that's one sort of like, as the infrastructure and everything and liquidity all starts to come, you have to sort of you do use that telephone approach where you use the interim tech to find a way forward to continue to serve clients. And as you continue to grow, hopefully, Uniswap liquidity continues to increase, which we'll start to hopefully see with Unichain, and be able to, have the market and the infrastructure grow just ahead of you and kind of ride the edge of that wave in terms of, being a good surfer as an entrepreneur, I guess. But no, it's really remarkable. I've seen a lot of the stuff you guys have done, and obviously the KKR tokenization is pretty incredible. I think having names like that come into the space is just wildly, impressive. So would love to hear. I mean, even from you guys, I know, hopefully it's not just a full interview of myself, but John, would love to hear what it's been like to work with such big names and kind of find ways to, show them the benefits and the unlocks of a lot of this infrastructure.
Well, to work with big names, you have to create value for the big names, or at least the promise of value at some point. And they have to go through three hurdles. One is understand the technology. Two, understand why it's what benefits them in doing this. So not just understand the technology, but what are the business benefits to them. And lastly, and this is the whole Clay Christensen thing, is like, how do I, these are mega organizations. Blackstone's $1 trillion in assets managed, KKR, Apollo, each like $500 billion. It's kind of like, how do I go into these niche areas and do these things without disrupting my existing business? So those are the three hurdles you have to get through. And obviously there's the general regulation and sentiment of the space, all of that. So I think what ultimately needs to happen, and this is why I'm so excited to talk to you, J. Paul, is you do need that startup, that new person who understands the products, understands the technology, but is willing to go after a niche space, because they will not be the first mover. They will be a fast follower, but you need a J. Paul and Collar to create that product and let it get somewhere before they are willing to move. So it's fun working with them, but it's just as much fun working with the Collar networks.
100%. No, one of the, great opportunities exist at like the overlap of two big spaces. And I think like the times where you put yourself in front of that, I think, I was going to use the Steve Jobs calligraphy example, but like that's a pretty boastful example, so I don't want to use that. But I think like any Brian Chesky in design. It's like having sort of that like, that obsession over one area and understanding and being able to bring that into a totally new market where you get the competence. And the other thing is, you can always hire for the specific expertise that you need that you really need, or bring on a co-founder or make it a team sport, because at the end of the day, it's about just getting to something quickly that's going to work, that's going to make people happy, and being able to, I think at first I was like, oh, I'll try to just do it all myself and like write all this code and like teach myself. But the more I like, tried to just continue to like humble myself and be like, no, you're not that good at you're bad at React. You've only been doing it for like 4 months. Like, you need to hire somebody to go focus on that. And seeing just how much faster things get done is pretty remarkable in terms of, being able to bring on teammates that basically know another piece of the area. And you need all of it. You need marketing, you need all of it. So
that self-awareness shows a lot of maturity. And if I were a venture investor, hearing that from you would make me more confident in wanting to invest in Collar.
Well, what's funny is I didn't have this self-awareness until after the round happened, and then, so I don't want to pre-announce anything, but that, and then, basically bringing on hiring where you then get humble. And it's like, oh, I mean, you get hit over the head with it.
That's right. Sometimes, as smart as, people are, they kind of need to get hit in the face a few times before they are actually effective and good at what they do.
And I probably should have been, hit in the face a little bit harder earlier on. But, I don't know. I think it's one of the best things you can do. I think is like, if you're like 15 or 18 or like, listening to this, like, go try a startup. You will like, cause I remember how, confident every like 16-year-old is about everything. They think they know everything. And you'll find out really quick that like nobody wants to buy your lemonade because it's like not as good as, as like the place down the street that's like selling, this perfect thing in a perfect box at Walmart at your disposal. It's like, go learn what the market's really at.
It's true. I mean, the first-time entrepreneur, and not just crypto ones, but also Web2 ones, their attitude belies no doubt, insecurity, or just pure confidence and conviction. And that's a false persona they take on.
Well, it's like, what's funny is the only way that they would ever do it is if they didn't know how hard it is. And so, but yeah, no, I think it's really just the first like 6 months that, 6 months to a year, I'd say is the hardest. And then it just gets easier. I mean, I don't know. The problems get bigger, but there's a really good analogy that Alex Hormozi, this guy, uses, who's a huge YouTube personality. He's like, at first it's, you with a stick against a bear, and you have to find a way to like win that battle. But then, because later on it's like, you versus a dragon, but like you have, tactical nukes or something. Like, I don't want to get us, demonetized here or something, but basically, that's an easier battle than, just getting that first customer, and getting somebody to care.
Now, on a different level, I bring the conversation not necessarily to Collar, but to just general decentralized finance. And I won't name specific protocols, but what's fascinating is you see, obviously, the lending, borrow, using collateral, like what you're doing, or creating a covered call strategy where it's, tethered to some realism, is all great. But then you see certain DeFi apps, and again, not to mention names, and I'll try to be as vague as possible so I don't bring any specific ones. But then you look at what they're doing, and then you speak to these founders, are very smart people, and you realize they have zero financial experience, but somehow they got to a place where they're doing effectively CDO squares as some sort of structured product. And then you're thinking to yourself, wait, this actually played itself out once before in a different world. And now we're just replicating it in the Web3 world without them even having, and these are young people who were like babies when 2008 happened. So they don't really understand it or really know about it even. Is there a fear that Web3 has so much of this repeat of the mistakes that have been already made in traditional finance without even the, again, not in your case, but in a lot of these founders?
I think at least we're speed running it, right? Like, it's all going to happen, and it's probably unavoidable because like the players are just different, and they haven't had the same lessons. Their LLMs don't have that training, which is pretty spooky to start seeing playing out. But I think it's I think it's somewhat unavoidable, but hopefully, it's really hard to take advice when you haven't lived what that person's lived. And And I think that's something that, we'd all do better to like assume that I think that one thing that's actually underdone in the space right now is, people don't look into why all these laws are in place in terms of like AML, KYC, like all this stuff. It's there for counterterrorism. Like it's there for like things we should all be against. So like, why like I'd probably get, I don't know, maybe the ultra decentralized, we shouldn't cancel anyone, which I still really, I like believe in a lot of that, but there's lines somewhere. And I think that's if you look into like why, a lot of this, like the 33 and 34 acts like came into being, it was like people were just launching all kinds of crazy things. And, that's what stopped it. You make it just hard enough to launch something that like only people that are.
But that is absolutely true. And I'm conscious of the time, so I'm going to keep pushing the questioning. Your Colo Vault's going to be successful, but what's after that?
Yeah, one big one is called an accumulator strategy. So if you've ever accumulated a position in Bitcoin or ETH, this one's always a fun one because people just think it's completely impossible. But basically, imagine you could buy ETH at a 20% discount to spot every week for a year. Now, there's a ton of catches. And this was a Goldman invented product. There's always catches. But basically, the catch is you have to buy twice as much if it's down more than that. Or if it goes up 5 or 10%, the trade knocks out. So basically being able to have a better accumulation strategy. This is actually how share buybacks are done for corporates. And it was originally a retail product that they repurposed for corporates. But yeah, that's one. That's a very bear market product. So we think Color is more of a bull market product. So it'll hopefully give us some business diversification.
I didn't realize that was first tested out on retail before it became a corporate buyback strategy. Interesting. What's the name of that derivative strategy?
Buy below market or accumulator. And there's like a bunch of other derivatives of they're also crazy where it's callable by the issuer and stuff. But, basically the hardest piece of it all is collateral like management and requiring it up front. So having that formalized in smart contracts will make things, I think, a lot easier. But yeah.
What do you think needs to happen on a more macro level, maybe on a political level, whatever, for your product to take off?
I think we're prepared for kind of both regulatory, like both presidential kind of outcomes in terms of the regulatory side. What's crazy to think about is on the Trump side, it's like, are things that we're preparing for now like no longer going to be like perimeters? Like, if imagine you spend all this money on legal and compliance and then like it all just goes away. Like, it's weirdly frustrating in a way, but I guess I guess that's a good thing as long as you're acting well. But yeah, no, I think having the default stance change to positive, it's sort of like having the cop pull you over and say, nice to meet you, son. And, here's how fast I think you were going, and being friendly versus, coming in pretty hot and assuming the worst. There's a lot of discretion in that power that's like, we've clearly seen play out. And so yeah, I think it'll be very interesting. And we're watching it with close eyes.
With that, maybe let's move to a lightning round just because we have a couple of minutes left. And, this one, I explained it up front, but just very quickly, we'll give you a term or word or phrase. Just give us the first thing that comes to your mind. No holds barred, unfiltered.
Let me start.
And if you want to give us a couple at the end, you can.
I'll start.
Okay.
One of my favorite subjects, DePIN.
Probably one of the most heavy PMF areas there is in crypto. I can't wait to see. Just PMF is the first thing that comes to my mind. Like, and it's just incentives like personified, and I'm psyched. I'm like, yeah. So,
Donald Trump.
Bitcoin. I think he's just gonna. I think it's. a million Bitcoin on the balance sheet is a big deal. Having it be there intentionally. So that's kind of my first reaction.
I think one of the most exciting things that I've seen in the last week or so, Truth Terminal.
I think the AIs are going to be better at things than us, and they're going to be richer than us, and we're going to love it. It's crazy to start to see it, but like I would let certain things run a company. Like it's coming.
AI agents broadly.
I think it's similar. The problem is like none of it really works yet. Where like if it can't get me something on DoorDash, like what are we talking about, right? So that's my test. DoorDash, Uber, like can it do things for me? Can it plan a trip? Can it do it the way I'd want it? Because if it can't, I'm not using it.
Okay, and last one. Since we're talking about Web3, and this has been talked about recently, value capture. Is it going to be the layer one? Is it going to be the application or in the wallets?
I really think it's the applications. I think that's where the users are. I think that's where you can have a moat in terms of an experience. And the infra is only as good as the app's there. I mean, that's at the end of the day, infra is disposable. You can, if you're selling the next thing they're going to use. I mean, I saw a company recently that was doing recycling for old spent GPUs from the last generation. And if you're the old GPU, like you're kind of toast. But if you have, economic moats and stuff like that, that's all important too. So that'll be a tough one to see play out. We'll see.
Awesome. With that, guys, I think this has been another awesome episode. J. Paul, thank you so much for your time. Thank you for taking us through what you're building and why it's so exciting. And John, as always, love co-hosting. So excited to see you on the next one. J. Paul, maybe the last thing before we close up here. Where can people find you to learn more? If I'm trying to use the protocol, is that something I can do today?
Yeah, so we're in beta. We're launched. You can use it at beta.collarprotocol.xyz. And follow us on Twitter at Collar Protocol.
And then John.
I'm on X at John the number 1 Wu, and LinkedIn. Either way.
Awesome. Well, thanks again, guys.